Happy Monday, everybody. I hope you had a good week. What a week it was. I hope that this update does not disappoint you. As we do every Monday, let's review the past week and let's preview the week ahead. Today is August 12th, 2024, and this is your Monday market update. Let's take you back to last Monday, actually starting last Sunday night, all the way through the open on Monday. Futures were seeing a sea of red. Japan had the worst drop since 1987, down 12%, really 12% in one day. Hong Kong was down 1.5%. China was down 1.25%. Australia was down nearly 4%. Even Taiwan was down almost 8.5%. I think the biggest chip making country. South Korea was down almost 9%. So, as it always confuses me, US markets were down the prior Friday. So maybe those international markets followed us and playing catch up, but that's not what the story was. We were following the global markets again on Monday, but really the U.S. markets on Friday started this all, and the growth scare that we spoke about last Monday was one of the main drivers. I'm not going to go back through the jobs numbers and the Powell news conference. We did that last week. What really moved markets on Monday? Well, get ready for the words of the week. Yes, yen carry trade. I've been watching this. One of my research teams pointed this out a few months ago as one of the many risks still left in the market. First things first, let's talk about what the yen carry trade is. Essentially, it's a strategy where investors borrow money at Japan's super low interest rates, and then they invest that money in higher yielding assets elsewhere. It's been a popular strategy because Japan's interest rates have been nearly zero for a long time. But when things change, like interest rates going up, it can cause a lot of turmoil. What happened to bring us up last week? Last week, the Bank of Japan unexpectedly raised interest rates by 15 basis points. This move caught a lot of investors off guard, led to a wave of margin calls. Investors who had borrowed yen to invest in other assets suddenly found themselves needing to unwind their positions quickly. This meant selling of those high-yielding assets, which caused a lot of volatility in the market. Overall, markets opened lower. The Dow was down over 1,100 points, almost 3%. S&P 4.25%. The Dow was down over 6.25%. Again, that was at the open. The only big economic news was the ISM service PMI, and it was an important one. We need to see the service sector stay in expansion territory, and it did, from 48.8 last month to 51.1 this month, beating estimates, but not enough to change that runaway market for Monday at least. We saw the lows put in early. How bad was the pain? From the highs, the Dow was down about 6.5%. The S&P was down almost 9% from its high, and the NASDAQ in correction territory down almost 14% from the high. News of Warren Buffett selling half of his Apple shares pushed that one down. But recall that at one point before the selling started, it represented 40% of his portfolio. And I'm sure I've told you many times, if you have one large position, it's a matter of risk, plain and simple. But Apple did sell off on the news and the bad tape too. After the close and pretty much all day in the midst of the carnage, everyone lined up to say this was opportunity. So please recall that, as I've told you over and over again, on average, the S&P 500 averages 10% decline every year, and we are not even there yet. At the end of the day, the Dow was down 2.5%, the S&P was down 3%, almost exactly, and the NASDAQ was down almost 3.5%. Turnaround Tuesday was in full play as stocks gapped, mostly higher at the open. It was more of a stabilized Tuesday, but after a sea of red on Monday, markets were happy to have that. Japan rallied back over 10%. Now, if you think our boat is everyone on one side running to the other, as I tell you all the time, Japan was down 12 and up 10. Now, that'll make you seasick. Eco data overseas was solid, and even a solid 3-year treasury auction helped to keep things in the green. Buying did dry up at the end of the day, but markets held some of their gains. At the end of the day, the Dow was up 0.75%. S&P and the NASDAQ held on to a 1% gain. Stocks did attempt to rebound again on Wednesday. They started off with a comment from the Bank of Japan, basically saying, that rate hike that we threw this whole thing out of whack? Well, we're not going to do that again, at least for a while. There were some underwhelming earnings from Disney and Airbnb, and that's not good for the travel trends. And on the tech side, Supermicro was a mixed report. Market held the gains for most of the day until a poor 10-year treasury auction took the wind out of the sails, and the sellers came back in. More likely, along with that, the buyers dried up also. Selling was pretty heavy into the close. The Dow closed down about 2/3%, S&P down 0.75%, and the NASDAQ was down a bit over 1%. Thursday resumed the relief rally. Jobless claims came in better than feared, and that was enough to be good news is good news in this case. The bad news got to be bad news to be good to. Let's try this again. The bad news got too bad to be good news in labor markets, at least. Now, going back to the last non-farm payroll reports, this report on Thursday was enough to convince people that the labor markets were not falling off a cliff, and that was the fear as the markets picked up on a very slight pickup in the unemployment rate from the last report. Thursday's report was enough to keep markets looking for rate cuts, but no longer calling for an emergency meeting and an emergency cut. While one noted market commentary, a bullish one, was very clear in Monday's sell-off that the Fed should meet immediately, have an emergency meeting, and do a three-quarter cut emergency cut. It was looking to be a little bit of an overreaction, obviously. By the end of the day, the Dow was up 1.25%. The S&P was up over 2.25%, and the Nasdaq was up almost 3%. Markets rolled on come Friday as Taiwan Semi reported a number that brought some solace to the tech trade. Geopolitics do keep the markets honest. The Middle East was obviously concerning going into the weekend. Markets did open slightly lower, and it looked like Friday was to be the day to determine if we had a green week or a red week, something we could not have imagined on Monday. As earnings season is coming to a close, there will be some laggards. No takers yet on my trivia question from last week, so here it is again. NVIDIA, arguably one of the most influential stocks in the past year. It does not report for another few weeks. Why are they off the normal schedule? Any ideas? Email me or call me. At the end of last week, we had 90% of the S&P 500 reported already. 78% of them beat estimates, pretty much in line with history. We'll talk about some of the remaining 10% coming up this week in just a minute. As the week came to a close, much like we've seen a lot of things, were not as bad. A lot of times, things were not as bad as it looked from Monday. At the close on Friday for the day, the Dow was up slightly. The S&P and Nasdaq were up almost 0.5%. For the week, the Dow was down 0.5%. S&P just barely down in the red, and the Nasdaq was down less than 1/4%. After being down almost 10% from the high as of Monday's low, S&P did come back, closed the week down just over 5.5% from the high. The Dow was down about 3.33% from the high, and the Nasdaq down still a bit over 10% from its high. Not as bad as you would think. And if you listened to the news on Monday, you heard all the dire predictions come out. They pulled out that playbook once again, and they put it away by the end of the week. Let's preview this week. On the eco side, we will get PPI and CPI Tuesday and Wednesday, and some housing data also. We'll get small business optimism on Tuesday, and I do watch that. They usually have a pretty good handle on things. I think the report of the week will be retail sales. Yes, PPI and CPI will try to suck all the oxygen out of the room as to how they affect the Fed, but I still think retail sales and some of the earnings will have more staying power for the long term. We will also hear from the University of Michigan on their survey on sentiment and inflation expectations. Again, notable, but I still think it will be taken in stride. Fed heads are back, but it's still summer. Some of them must still be on the beach. We'll get Bostic and Musalem, Harker, and Goolsby. Finally, as I said, I think the key reports: Walmart, Home Depot, Cisco, Applied Materials. So let's hope things are not quite what they were last week. But I guess if you slept through last week, or as often the case, or as I prefer to describe it, if you kept your eye on the long-term goals, you would have never known last week saw such moves. Remember, it is the summer. Trading desks are less full, and volume tends to be lower, and thus volatility. And I've been telling you that for a while. We are seasonally not in a good spot for the bulls, but we know we live in historic times. Please keep an eye on things. Please keep the hostages in mind. They are going on 311 days. For now, I'll keep watching and I'll keep you informed. Stay safe and stay in touch. Have a great week.